So
I bet.
the slide you had up earlier was on bank failures.
So check
We
this
got
out.
her.
Obviously, we were all in the business in 2008 when the real estate crisis happened. Um, and the big thing about that real estate crisis was that they let a couple of big banks fail. And had they not let those banks fail, probably wouldn't have been as bad as it was. But now looking at the numbers, and this is a New York Times article, this is the US bank failures in 2008 versus 2023, among other years as well. And it's adjusted for inflation. So, in other words, this is like dollar for dollar. And if you look at the three most recent bank failures, they exceed the number of banks in value that crumbled in 2008. So there was, I think it was 500 banks between 2008 and 2015 in the US that failed. And basically what happens is the FDIC takes them over and then they sell them off to another bigger bank. And ultimately that's what's happening with all of these banks, Silicon Valley Bank being the one that was the biggest in the news, and now First Republic being the second biggest bank failure in US history, 213
Wow.
billion, which is an absurd number, right? And it leads to a whole bunch of questions, and some questions that I think I want to point to Greg at. And we've talked about the story of coming off the fishing trip, coming into cell phone service in one of the other episodes. So make sure if you want to see that story, you go and you check out the other videos. But we talked about kind of learning that happened. What we didn't talk about is what that meant for the mortgage holders. And by the way, when this all happened, this affected a pretty significant amount of Canadian banks and Canadian lenders, because we saw a lot of lenders disappear from the Canadian market pretty much overnight in 2008, right? So, what do you remember about that, Greg, with respect to the banks coming and basically, well, the banks that left, let's say, and what happened to the people's mortgages when those banks failed or when those banks left Canada?
I think more of what happened was around values because unfortunately we followed suit with what happened. Our banking is really tight, so we didn't have the same issues they had in the United States, but we saw terror uh, go through people, and we saw values drop in our housing market by 25% pretty well overnight. And so, people that had bought a home and put 25% down, or people that were building homes, we had a lot of construction financing going on because before that, it was really a busy market. All of a sudden, 25% equity in there was gone. So, and then you're holding on these properties and selling them at lower costs. So we saw a lot of people really, really suffer through that time period. It was devastating. It was absolutely devastating. And the beauty of our situation is, I keep coming back to, the most important economy is your own economy and what comes out of your pocketbook. So, and how do people adjust to that? And you know what? You had to adjust pretty well overnight. And there was lots of people that lost lots of equity. So I think losing touch or losing the opportunity to deal with some of these institutions that a lot of them were from the US and were lending up here in sort of the alternative stream as well. And all of a sudden they pulled out, it caused a lot of havoc. So our Canadian banks, bless their hearts, kind of came to the party and helped out a bit.
Well, you'll find this one interesting because this did not exist, what I'm going to show you right now, back in 2008. And that is that there's at least two of the biggest banks by total assets in the US that are Canadian banks now.
Wow.
And this is because a few Canadian banks went on buying sprees in the US after all those bank failures. And this is the one that's interesting because we've seen the stories about TD Bank now being the most shorted bank in the world.
Mm-hmm.
And I haven't really have you guys dug much into why that is?
Not hugely. I think it really boils down to exactly this. People are looking at it going, okay, there's cracks in the banking system in the US right now.
Mm-hmm.
And TD Bank is very involved in the US's banking system. So they're kind of, combining those things together a little bit. I
Yeah.
think that might be it. I mean, I haven't done a deep dive into it, but
The other
if
part
I
of
was
it,
to speculate,
the other part of it too, is that diversifying, and if there's if it creates opportunity, why not go after it? I think that's the big part of it too.
Yeah, absolutely. And they definitely did diversify into the US. Now, the big thing here and the big difference from what I can see is that the Federal Reserve and the FDIC in the US are making sure that these banks, if they do fail, are basically swept up pretty quickly, and they are and the depositors are made whole. Um, that's a little bit different than what happened in 2008 when they let Lehman Brothers collapse and decided not to inject a bunch of money. Now you see, I think it was a bunch of the big banks injected $30 billion into First Republic Bank um, last month. And the reason why they did that was because they knew as a whole they needed to protect the system. So it seems like this is a little bit different than 2008 from the perspective of they're protecting the system better, which would imply that we're not going to see massive reductions in real estate values because the banks aren't being let fail in the exact same way. But it leads to an interesting conversation around what's actually happening in the real estate market.